Hello students, this is Mrs. Jennifer Cruz from Lilavati Lalji Dayal, College of Commerce. And in today's class, students, we are going to study secretarial practice, chapter number 2, sources of corporate finance. Okay, so before starting with this chapter, students, let me tell you all that the total weightage of this chapter is 25 marks with option and 17 marks without option. Let us now begin with this interesting chapter. So the first topic that we need to understand is shares. Okay. So what are shares, students? So as per the definition of the Companies Act 2013, share means a share in the share capital of the company and includes stock. Okay. So share is nothing, students, but it is the smallest unit of the total share capital of the company. Let's move on to the first topic, that is features of shares. Okay, so what share is? Share is the smallest part of the total share capital of the company. Now let's study the features of the shares. So first one is meaning. Okay, so what is share? Share is the smallest unit of the total share capital of the company. Next one, you have ownership. The owner of the share, students, is called as the shareholder. Okay, it shows the ownership of the shares in the company. Next one is distinctive number. Okay, so under this, students, distinctive number, every share has a distinct identity number of its own, which is mentioned on the share certificate. Next one, evidence of title. So the share certificate, students, is a title, is the evidence, okay, of the title of shares, which is, there in the hands of the shareholder. So the share certificate has a common seal, which shows that the particular shareholder possesses the number of shares. Next one is value of shares. Under value, we have the face value. Face value means the value which is printed on the share certificate. Issue price is the price at which the company sells the share. Then you have the market price, the price which is demanded by the forces of demand and supply. Okay, so the price which is determined by the forces of demand and supply is termed as your market value. Next, you have rights. Okay, there are certain rights of the shareholders, like inspecting statutory books, attending meeting, receiving dividend, right to vote. Okay, these are the rights of the shareholders. Income. Okay, the shareholders receive dividend as the part of income, as the return on share. Next, transferability. The shares of a public limited company, students, are freely transferable. Property of the shareholder. 9th point, here it is trying to say that the property of a shareholder is movable, means it can be transferred from one person to another. Then you have kinds of share. So there are two kinds of share, students. One is the equity share and second one is the preference shares. Okay, so let's have a quick recap of the features of share: meaning, ownership, distinctive number, evidence of title, value of share, rights, income, transferability, property, and the kind of shares. Okay, now let's move on to the next answer, that is equity shares. So just now we studied that there are two types of share. So the first type is equity share. Now what are equity shares, students? Equity shares are also known as ordinary shares. Okay, why ordinary? Because these shares, they do not have preference, okay, over receiving dividend and repayment of distinct capital. So they are termed as the ordinary shares. So the Companies Act defines equity shares as those shares which are not preference shares. So those shares which are not preference shares are equity shares, simple as it is. Now why it is called like this? Okay, so the definition tells us, the above definition can be revealed in these 2 points. First one, the equity shares do not enjoy preference for dividend. Okay, so they do not get fixed rate of dividend, preference is not given for dividend. Second, the equity shares do not have priority for repayment of capital at the time of winding up of the company. So when the company is winding up, first preference shareholders are paid off, then the debenture holders, and in the end the equity shareholders are paid off. Okay, so basically, students, equity shares are those shares which do not carry preferential right in terms of payment of dividend and repayment of capital. Okay, so that is why they are termed as ordinary shares. Let us now move on to the very important answer which can be asked in your board exams. Okay, features of equity shares. Okay, so there are 13 features, simple ones which you will understand better. First one is permanent capital. Okay, So the amount that is received from the equity shareholder, student, is not refundable by the company during the lifetime. Okay, these shares, okay, the equity shares become refundable only during the winding up of the company. That is why it is said that the capital of equity share is a permanent capital. Second one, fluctuating dividend. So the rate of dividend, okay, is not fixed. It depends upon the profits of the company. In case if the company has not made profit in a particular year, that time the dividend can lapse. Next one is rights. Okay, there are 4 rights: right to vote, right to have a share in the profit, right to inspect books, and right to transfer share. Fourth one is no preferential rights. So students, equity shareholders do not carry preferential rights in respect of payment of dividend. Okay, so the dividend is not paid to equity shareholders. It is paid to the preference shareholders first, and then whatever is left out is given to the preference shareholders. Next one is controlling power. So equity shareholders, students, they are known as the controllers of the company, as the real masters of the company, because they enjoy voting rights. Okay, they can exercise their votes, and that is the reason they are termed as controllers or the real masters of the company. Then you have risk. Okay, so equity shareholder, students, they pay maximum risk. Okay, they are also termed as shock absorbers of the company, because they absorb shock. Okay, they take risk because sometimes they can get a very good rate of dividend, sometimes very less or no dividend. Capital also is paid in the last, but still these people take a risk and they invest into the equity shareholders. Next point is residual claimant. Okay, so residual means in the last. Okay, they are the last people who get their capital, their dividend. Okay, so they, equity shareholders, are termed as residual claimants because they get all their earnings. Okay, after everything is being paid. Okay, so the last earnings that is there is in the hands of the equity share. Hence, they are called as residual claimants. 8th point, no charge on assets. So equity shareholders, students, do not create any charge over asset. The 9th point is bonus issue. So equity shareholders are entitled to get bonus shares. Now what are bonus shares, students? Shares that are issued free of cost to the existing equity shareholders for the risk that they are undertaking is called as bonus shares. So this bonus issue is done to the equity shareholders. Next one is right issue. So students, what is right issue? If the company, okay, is in need of more funds for expansion, for growth, for diversification, then it issues certain shares to the existing equity shareholders, and that is termed as right issue. Next one is face value. The face value of the equity shareholders is very, very less. It starts from ₹1 to ₹10. Then you have market value. Okay, so here the market value, it depends upon the factors of demand and supply. Okay, demand and supply again depends upon the profits that a company makes. So market value also keeps on changing. Last one is capital appreciation. So here in students, there is a concept of capital appreciation. The capital can be appraised. Okay, the capital can become more in the equity shares. Okay, because the market value depends upon the forces of demand and supply. So every time your capital can be appreciated if the market value is good. Okay, so with this we've completed features of equity shares. Let's have a quick recap on the points. Okay, so first one, permanent capital. Then we have fluctuating dividend, rights. No preferential right, controlling power. Risk, residual claimant. No charge on asset, bonus issue. Right issue, face value, market value, and last one is capital appreciation. Now, there are 2 types of equity share, students, just for your understanding. First one is equity share with normal voting rights. Second one is equity share with differential voting rights. Now, what is normal voting rights? Voting rights of such equity holder is in the proportion of his shareholding. Okay, whereas equity share and differential voting right, what is it? They have varying rights, okay, regarding dividend, voting, or otherwise, in accordance with the rule of the Companies Act. Okay, so this is what is there. 2 types, with normal voting rights and with differential voting rights. Then students, let's come on to the next answer, and that speaks about preference share. Again, this is a very important answer for your board exam. So in this, you will study two things. One is features of preference share, and second one is types of preference share. So what is preference share? First, let us understand that. So shares which carry the following preferential rights are termed as preference share. Let's see what two rights that they have. So a preferential right as to payment of dividend during the lifetime of the company. So they receive preference over the payment of dividend. Second, a preferential right as to return of capital in the event of winding up of the company. So when the company is winding up, the repayment of capital is first done to the preference share holders. Okay. So the word preference is like they carry preference. They carry the first rights in terms of receiving dividend and repayment of capital. Let us now move on to the features of preference share, students. Now, what are the features? First one is preference for dividend. As in the last slide you already saw, preference shareholders, they have a preference over receiving dividend. They receive a fixed rate of dividend. Okay, first preference shareholders are paid before paying to anyone else. Second one is preference for repayment of capital. So students, here in the preference shareholders, they have a preference over the equity shareholders in repayment of capital. Then you have fixed return. So preference shareholders, students, they have a fixed rate of dividend. They get a fixed rate of dividend. It does not fluctuate, okay, in any form. Next one is nature of capital. So here in students, this will not be termed as a permanent capital, okay, because this capital of preference shares can be redeemed after a particular period of time. Then you have market value, okay. So again, the market value does not change, okay. The market value of all the preference shares does not change because here there is no capital appreciation. Next one is voting rights, okay. Preference shareholder students, they do not enjoy normal voting rights, but they vote in the matters affecting their interest. Next one is risk. So here in students, there is very less risk involved in the preference share investment because here they get a fixed rate of dividend. Their capital is also redeemed after a particular period of time. So the risk is quite less. Okay. Next one is face value. The face value of preference shareholder students is very, very high. It starts from ₹100 and it works in multiples of hundreds only. Next one is right or bonus issue. So your students, the preference shareholders, they do not receive a right issue or bonus issue, but they are only given to equity shareholders. So right shares and bonus shares are not entitled, they are not given to the preference shareholders. Then you have nature of investor. So investors who are very cautious, who are very alert, okay, who give more importance on security in their investment. These types of investors, they invest into preference shares, okay. So they are the cautious investors, we may say so. So these were the features of preference shares. Let's have a quick recap on the points. First one, preference for dividend. Second, preference for repayment. Next, you have fixed return, nature of capital, market value, voting rights, risk, face value, right or bonus issue, and the last one is nature of investor. Let us now move on, students, to the next answer, that is types of preference shares. So types is also one of the important answers that may be asked into your board exams. So first type of preference share, students, is cumulative preference shares. So what is cumulative? The dividend on these shares, okay, goes on accumulating, okay. If dividend is not paid in a particular year, that dividend is paid, accumulated and paid in the next year. So that is cumulative. The dividend goes on accumulating. Non-cumulative, here the dividend does not accumulate. If the company has not made profits this year, if they are not declaring the dividend, here they will not, their dividend will not accumulate. That dividend for that particular year will lapse. Okay. So dividend is only given out of the profits of that particular year only. Next one is participating preference shares. So participating preference share students participate in the surplus profit of the company. Okay. So if the company has made surplus profit, they participate in that surplus profit. Next one is non-participating. They do not participate into the surplus profit of the company. They get a fixed rate of income. Next one is convertible preference shares. Shares that can be converted into equity shares are termed as convertible preference shares. Non-convertible matlab those shares which cannot be converted into equity shares are termed as non-convertible preference shares. Then you have redeemable preference shares. Shares which can be redeemed, okay, can be paid back after a certain period of time, can be termed as redeemable preference shares. Irredeemable means the shares which are not payable, okay, it is only payable at the winding up of the company. You cannot redeem it in the middle of the year. So those shares are termed as irredeemable preference shares. Okay, so 8 types of preference shares, students. First one is cumulative, non-cumulative, participating, non-participating. Then we have convertible, non-convertible, redeemable, and irredeemable. Okay, now let us move on to the next answer, and that is debentures. Okay, now what is debentures? According to the Companies Act 2013, the word debenture includes debenture stock, bonds, and any other instrument of a company evidencing a debt, okay, whether constituting a charge on the asset of the company or not. Okay, so basically, students, what is debenture in simple words? It is the debt, okay, the loan, okay. The debenture holders can be told as the creditors of the company. It is a type of loan that the company takes. Okay, so according to Palmer, what is debenture? Very beautiful definition given by Palmer. So a debenture, okay, a debenture is an instrument under seal evidencing debt, the essence of it being in, admission to indebtedness. Okay, so it is an instrument under seal which is evidencing debt. Okay, next slide, students, we shall study the features of debentures. Now, what are the features of debentures? Very important answer in your board exam. So first one is promise. Okay, so debenture, students, is a promise made by the company that it owes a specified sum of money to the holder of the debenture. So the company here promises to pay, okay, the person from whom he has taken the debenture. Next one is face value. So here normally the face value is higher. Okay, it is at rupees 100, and it is always in the denominations of rupees 100. Time of repayment. Okay, so debentures, they have a due date, okay, which is stated in the debenture certificate. Okay, the principal amount of the debenture is repaid at the time of maturity. Next one is priority of repayment. Okay, so the debenture holders have priority in the repayment of the debenture capital. Next one is assurance of repayment. So debentures, okay, they are called as a long-term debt. Okay, since they are a long-term debt, they carry an assurance of repayment. Sixth point is interest. Okay, so a fixed rate of interest is agreed to be paid to the debenture holders, okay, for the debentures that has been taken. Next one is, students, parties to debentures. Now there are 3 people involved. First is the company. Company matlab the entity which borrows money. Second is the trustee. Okay, so the company has to appoint a debenture trustee if the offering of debentures is more than 500 people. So if more than 500 people are there, that time the trustees come in. Then we have the debenture holders. They are the party who provide loan and they receive debenture certificate. Next point, students, is authority to issue debentures. Okay, so the board of directors have the authority to issue debentures. Next, status of debenture holders. The debenture holders are termed as the creditors of the company. Okay, they are given the status of creditors. Next one is no voting right. Debenture holders, they do not, carry any voting right. Security, herein the debenture holders, okay, they have to create a charge over asset as a security. Next one is issuers. The debentures can be issued by both public and private company. Listing, okay, listing, the debenture should be listed in at least one recognized stock exchange. Last one is transferability. It can be easily transferred. The debentures can be easily transferred through the instrument of transfer. Okay, so with this we've completed the features of debentures. Let's have a quick recap. own the features of debentures. So the first one, students, is promise, face value, time of repayment, priority of repayment, assurance of repayment, interest, parties to debenture, authority to issue debenture, status of the debenture holder, no voting rights, security, issuers, listing, and transferability. Let us now move on to the next one, that is types of debenture. So again, we have 8 types of debentures. So let's study each one of them in detail. First one is secured debentures. So secured debentures, students, are secured, okay, by creating a charge on the property of an asset, okay. There is a security which is there, okay. The property of the company may be kept as security, okay, against the loan. So these are secured. Unsecured debentures, these debentures, they do not have any security. But now, students, after the Companies Act 2013, no unsecured debentures can be issued. Next, you have registered debentures. So registered debentures are those debentures in which the name of the holder, the address, the details of the debenture holders are recorded in the register of the debenture holders, okay. Bearer में names of the holders are not recorded, okay. They do not appear in the register of debenture holders. Redeemable debentures, these debentures can be redeemed, okay. That is, redeems means it can be payable at the end of a particular period, maturity period. So that is redeemable debentures. Irredeemable are those that are not repayable, okay, during the lifetime of the company. It is only payable during the winding up of the company. Next one, convertible debentures. Convertible debentures are those debentures that can be converted into equity shares. And non-convertible debentures are those debentures which cannot be converted into equity shares. So simple 8 types of debentures, students: secured, unsecured, registered bearer, redeemable, irredeemable, and convertible, non-convertible. Let us now move on to the next answer, and that is bond. Okay. Now, what is bond? Bond, in simple words, students, it is again a debt security. Okay. It is a contract to repay the borrowed money with interest. Okay. Basically, it is a loan, and the holder of the bond is who? The lender to the institution. So basically, he becomes the creditor of the company, and he gets a fixed rate of interest. So basically, bonds, okay, they are the debt security. It is like a loan, okay. They are the creditors of the company who gets fixed rate of interest. Let's move on to the next one, students, and that is features of bond. So we have 4 features. First one, nature of finance. So it is a debt finance, okay. It provides long-term finance, like for a longer period, 5 years, 10 years, 25 to 50 years. Status of the bondholder. Okay, just now we said that the bondholders are the creditors of the company. Now, since they are the creditors of the company, they are non-owners of the company. They do not participate in the general meeting, and they do not participate in the management as well, and they do not even have the voting rights. So third one is return on bonds. So bondholders get a fixed rate of interest. Then repayment, okay. So, you know, bonds have a specific maturity date where the principal amount is repaid. So 4 pointers: nature of finance, status, return on bonds, and repayment. Let's move on to the next topic, that is ADR and GDR. What is ADR and GDR? ADR stands for American Depository Receipt, GDR Global Depository Receipt, okay. Now, a depository receipt that is traded in United States of America, USA, okay, then it is called as JDR. And global depository receipt, when the depository receipt, okay, is traded in country other than USA, okay, then it is called as GDR. So USA is ADR, other than USA is GDR. Now, let's come to the distinguish between parts, students. So this chapter, basically, let me tell you, the 5 answers that we did just now is very, very important. The 8 marks question that is answered in your board exam, 1 question will surely come up from these 5 questions. That is equity share and its features, preference shares ka features, preference shares ka types, features of debentures, and the types of debentures. These 5 answers are very, very important. Now, even all the distinguish between in this chapter is very, very important. One distinguish surely will come from this chapter only. So let's see. First we have shares and debentures. Very important distinguish between. So we've already studied. We'll have a quick recapitulation of whatever we've studied. So share is a part of the total share capital of the company. Okay. What is debenture? It is a certificate of loan taken by the company. Okay. That's it. You must remember this one. Status. Okay. Now here, the holder of the share, who is he? The owner of the company. Whereas in debenture, he is the creditor of the company. So status, you have to remember owner. There you have to remember creditor. Nature, it is a permanent capital. That one, debenture, is a temporary. So permanent capital, temporary capital. Voting rights. So shareholders enjoy voting rights. Debenture holders do not enjoy voting rights. So here they enjoy, there they do not enjoy. Next one, return on investment. Okay, so what is the return on shares called? It is called as dividend, whereas return on debenture, it is called as interest. Okay, return on share is dividend, return on debenture is interest. Then security. Share, students, share capital is an unsecured capital. No security is offered. Whereas debentures is a secured capital. There they create a charge over the asset, okay, or the property of the company. Next one, time of issue. The shares are issued at the initial stage. Debentures are issued at the later stage. Then suitability, it is suitable for long term. Here it is suitable for short term or medium term. Okay. Then we have the types. Shares are of two types, equity and preference. Debentures are of 8 types, which we studied just now. Registered bearer, secured, unsecured, redeemable, irredeemable, and convertible and non-convertible. Then last one is the position on liquidation. On liquidation, the shareholders rank last. Okay, so they will rank last. First, the debenture holders will be paid, then the shareholders will be paid. And in the terms of debenture holders, since they are the creditors, they rank prior means the first to the equity shareholders. Okay, so liquidation where they rank last and debenture holders rank rank first. Okay, so this is shares and debentures are distinguished between. Next important distinguish between is equity shares and preference shares. Very, very important. So meaning, what is equity shares? We've already studied. Let's recapitulate it. So shares that are not preference shares are called as equity shares, and preference shares. Preference shares are shares that carry preferential right in terms of payment of dividend and repayment of capital. Okay. So here they do not have any preference, and preference shares have preference in what? In two things, payment of dividend and repayment of capital. Next, you have rate of dividend. Okay, so equity shares are given dividend at a fluctuating rate. It keeps on changing depending upon the profits of the company. Whereas preference shares, they get a fixed rate of dividend. Then you have voting rights. So equity shareholders enjoy normal voting right. Preference shareholders do not enjoy normal voting rights. Next one is return on capital. Okay, so equity capital cannot be returned during the lifetime of the company, so it is called as a permanent capital. Whereas the debentures, the company can issue redeemable preference shares which can be repaid during the lifetime of the company. So equity is not redeemable, whereas debentures is redeemable. The nature of capital. So equity capital is also called as risk capital, whereas preference capital is called as safe capital. Then we have the nature of investors. The investors who are ready to take risk invest in equity shares, and here in debentures, the investors who are cautious, alert about the safety of their investment, invest in preference shares. Then you have face value. So here in students, the face value of equity share is very low. It ranges from 1 to 10, whereas preference share is higher. It ranges from ₹100. Then you have right and bonus issue. So equity shareholders are entitled to get bonus and right issue, whereas preference shareholders are not eligible for bonus and right issue. Next one, capital appreciation. So market value of equity increases, okay, with the prosperity of the company. Hence, it leads to the increase in value of share. Whereas in preference shares, there is no possibility of capital appreciation. 10th point is risk. Okay, so equity shares subject to higher risk. Okay, preference shares are subject to less risk. Here you have more risk, here you have lesser risk. Then types. Equity, we just have two types, with normal voting rights and with differential voting rights. Whereas preference, you have 8, cumulative, non-cumulative, convertible, non-convertible, redeemable, irredeemable, and participating and non-participating. Okay, so this was equity shares and preference shares. Now, the last one is owned capital and borrowed capital. Okay, so owned capital, basically the meaning first, it is that capital which is contributed by the shareholders, and borrowed capital is that capital which is borrowed from the creditors. It is also known as the debt capital. Then you have sources. Okay, this capital is collected by the issue of equity and preference shares, and borrowed is collected in the way of issue of debentures, fixed deposits, and loans. Next one is return on investment. So shareholders get dividend, okay, as a return on their investment, and here the debt capital, okay, they get interest as the income on their investment. Then status, the shareholders are the owners of the company, the debenture holders are the creditors of the company. Okay, let's see the next point. We have voting rights. The equity shareholders enjoy normal voting rights, and creditors, they do not enjoy normal voting rights. Repayment of capital, the shareholders do not enjoy priority over the creditors. Okay, here they are eligible for repayment only after making payment to the creditors at the time of winding up of the company. So repayment is not done first, but here in debt capital, in borrowed capital, the creditors get the priority over the shareholders in case of return of principal amount as well as the winding up of the company. Next one is the charge on asset. The shareholders do not have any charge on asset, and here the secured debentures have a charge on the asset. Okay, so with this, students, we've completed the three distinguish between that is there in your textbook. Okay, all three of them are very, very, very important. So this chapter, students, kindly revise all 5 answers: equity and its features, preference, its features and its type, debentures, features and its type, and then 5 answers, and then all 3 distinguish between. Okay, so all of them are very, very important. So with this, we've completed chapter number 2, sources of corporate finance. Thank you.